Street not being nice to Lululemon. Got a few ratings to cover. We'll talk about that rally on Friday, whether or not it will continue. Tim Quast back in the house after 2 Mondays off for the holidays, and maybe we'll give him next Monday off too for President's Day. Let's get things rolling, Mitch.
Coming to you live from downtown Detroit, this is Benzinga's Pre-Market Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I'd buy that stock for a penny.
With everything you need to start your trading day.
Good morning, traders and investors. I hope everyone had a good weekend. Follow through rally here. S&P's up over 15 handles at, let's call it 15 and a quarter at 39.30.75. Pre-market high 36 and a quarter. On the downside, we couldn't even see unchanged at 15.50. I'm a little disappointed about that. Let's go on to the buck. The buck is weak. The buck is down 33 cents at 103.31. The bonds, they're down almost 3/4 of a point at 128.18. Crude bouncing out of the lower 73 handle up 246 at 76.24. Gold knocking on the door at 1900 up 990, 1879.60. Silver back over 24 up nearly 12 cents at 24.10. And we got a monumental rally going on in Bitcoin here. We've gone from 16.8 to 17,255. That's up $360. Let's bring in Triple D, Money Mitch to start the week here, folks. And first of all, Money Mitch, I thought you'd be wearing a Finn shirt after those three field goals. Yeah.
And then I couldn't rock my Tua, though. I couldn't rock my Tua, you know.
And then the Lions.
They find a way to lose. Even though they win, they lose.
Come on,
they
it's the Lions. Did you guys expect something else?
We're all excited. Watch Green Bay game, and then Seattle wins, and I don't even bother watching the game. And then they screw up the pick even further, too. So, you know, they should have just not even dressed any of their starters, really. Because the win did nothing to help them whatsoever. And, you know, honestly, they should have punished – I don't know. They should have punished Seattle for beating them and just not even dressed any of their starters. That's what I would have did at that point in time. But that's the Lions, so of course they win, but they really lose because they won. So that's enough Lions talk.
Yeah, we're not a sports show. We know we did.
We could be though.
A lot of.
I'd handle the hockey. You'd handle the college ball.
I handle it all.
Because that's just
let's go.
Boy, the way you were on the Red Wings overtime losses. I mean, I was like, holy mackerel! I thought I'd just throw a little tidbit in there that the Wings are doing okay. Reading the headlines, Triple D, 7 overtime losses.
We're all over it, man.
Yeah.
Well, the question is, was the market skating where the puck is going? Because it seemed like on Friday. That's what happened to the market, as we definitely got a lift, as non-farm payrolls came in slightly higher than expected, but wages increasing slower pace than expected. The bulls jumped all over this. Now, the only question here is, of course, was this the right move? Is this rally going to continue, right? Or was this kind of just a little trick bull upside move here? As data, of course, showing contractions in the service sector heighten the hopes that central banks' rates are accomplishing their goals. This is also one thing that I would point at is that Friday showed that household employment rebounded by a whopping 717,000 jobs last month. That's how many jobs we recovered and got the unemployment rate back down to 3.5 from 3.7. I'll kick it to you guys because I'm still in the camp that was the biggest bull trap we've seen all year. Haha, pun intended.
Maybe. It's tough. Like, I was on the fence after those numbers, and I was like, I don't know. Like, it was a very good number for the Bulls.
I mean, look at this graph. Then they gave
it back quickly, and I'm like, oh, here we go again. But they held unchanged, and then all afternoon they just couldn't stop rallying it. So I was torn. The reason I still going to hold a lot of cash, the reason I'm not jumping into this market is that I'm concerned about the tape bombs coming. We got 2 more here this morning to talk about. They're both in retail. Lululemon warning and Macy's dropping the bomb Friday night, of course. When you could drop, nobody pays attention to it. They warned the holiday sales weren't great either. So we've got more and more signs still coming here that the consumer is starting to feel some pressure. The consumer might be slowing a little bit. I think we're going to get continued signs here as we get into this earnings season. I think we're going to get some warnings from the big dogs. Now, again, if the market can take all that in stride, then your bulls got a real case here, and they're taking it in stride here this morning with the S&P still trading up. But give us that Lululemon news here, Mitch, because this is not good for retail.
All right, let's talk about Lulu as they fall on their holiday guidance below expectations, narrowing their Q4 EPS guidance from $4.20 and $4.30 now to $4.22 and a $4.27 high estimate. There was $4.30. They also raised, though, Q4 sales guidance. They raised that to $2.66 billion. On the high end, $2.7 billion versus a $2.67 billion estimate. And just to include another stock, because I feel we should just talk retail together here, Macy's also putting out a warning here with Q4 sales coming in at a 8.16 to 8.4 versus 8.3 billion estimate. And also slightly adjusting their EPS outlook to $1.47 on the low end. High end still above the estimates of $1.60 to a high end of $1.67.
Just a slightly lower guide for both, but a punishment for both here too. Macy's down 4.65%. Lululemon really taking on the chin, obviously a higher PE here. So we never like to see any type of, little guidance lower because they nail you when you got the higher PE. Down 32 points, down 10% here this morning. So the double tape bomb market taking in stride, though. We're trading higher here. China's the catalyst, if you want to know. We'll get to that in a minute. I don't know what to say. I mean, this is why I'm scared of stocks right now. I'm just scared there's more tape bombs coming. And, you go and load up stocks. You say, oh, this Lululemon's starting to look, Joel, just imagine, your Thursday, then your Friday, and you're like, this Lululemon's starting around here, starting to go up. Maybe we got a little boo. And then boom, the fundamental tape bomb comes, and the technicals don't matter at all, and the stocks boom down, making new lows on the move. So it's tough. It's a tough fundamental environment, even though some stocks have really been beat up. I just can't jump in here and say, yeah, I love the trading action from Friday, and I do as a bull. It was very good trading action. But then you see 2 more little tape bombs. What's the market going to do when it's Apple, or if it's Microsoft, or if it's, Google, or if it's Meta, or if it's one of the bigger dogs? I don't know. We'll see. If the market can rally, if we get a situation where Google or Amazon warns and the market rallies on it, then that bull's really got a case. But, today, market's rallying on China, trying to hold green. Lululemon down 10% doesn't make me all hungry to just go out and buy stocks.
No, standing in front of these moves has just not been the call. So I'm not gonna try and pick a bottom in this today. We did get a nice bounce, I think, for Lemon investors. The low of the move back at the end of September was right around this 280 level. Actually, it was 277.60. You bounced off 280 this morning. You're $17 away from that, so I would use that as a longer term level. You did get a nice bounce off this one, so it's actually way off the low of the session. If it could bust above 300 today, maybe you get a little bit of a rally, long ways to fill the gap, but 280 low of the move, 280 pre-market low. That's what I'd be looking at. Nice bounce so far. Macy's, they snuck it in there after the close on
sneaky.
Friday.
That's dirty.
Yeah.
You got bad news. Let's drop it on the Friday night after the close, and nobody be paying attention.
No, well, maybe they can, ease it throughout the weekend, right? It through,
it's
right?
Fridays. We got football to talk about. Nobody will think about that Macy's. Kind of dirty, man. At least Lulu drops on the Monday morning. Here, it's in your face. That's dirty. Drop it on the Friday night. The Friday night tape bomb on the bad news.
Since we're talking Macy's and Lulu here, one thing that I think we should bring up is a company that has been very strong since their earnings, which would be Nike. right? And that definitely turned around this morning. And I think that this all has to do with the focus shifting towards margins. That's really why I think Lulu took a hit here. And you guys can see I'll let Joel give Macy's chart technicals, but we could also take a look at Nike, how that's falling this morning.
Yeah, not much.
I mean, that moves just before you go on the technicals, Joel. The Paris trade has always been, and again, Nike has been really blasting off, but it's been Lulu and Nike. I've traded that for years. Under Armour, we can throw in that too, full disclosure. I have a position on in Under Armour, so I won't talk too much about it. But here you are, Nike making new highs, breaking out. Now it gets a little tape bomb from Lulu. I mean, the trend, though, is definitely higher here in Nike, so is this just a buying opportunity, Mr. Technical Analysis guy, Joel Elconin? What are your thoughts here?
Not for me. I mean, this has been one heck of a run, and I probably thought it was overdone when it had to gap and go off earnings. So Nike's, it's traded 52,000 shares. We're down $1.80. The highest low of the move was 121.77. You haven't hit that. So if you take that out, definitely some more downside here. I think sellers will be stacking up anywhere near that close, that high close of the move, 124.53. So it's down but not out. The Macy's is kind of in no man's land. I think with the bad news out, why do you need to step in front of it right away, right? Trading 21.15, not even under $21 yet. Tons of support at 20 in Macy's, but I just want to make just a comment here. Thinking about it, made a comment. Let me scroll back up to it, and I think thinking about it, I think that's George Carlin on his handle. Do you guys remember who George Carlin was? You guys too young to remember George Carlin?
Yeah, I might be too young.
He was a great comedian.
I remember George Carlin.
Yeah. He says we could go sideways all year. Tape bombs and then some positive inflation news, a pop. I mean, 20 was a crazy year. 21 was a pretty crazy year. 22 was a pretty crazy year. Maybe 23. Maybe we're going to develop some kind of trading range here. I mean, that would not be out of the realm of possibilities. We don't have to rock it down to 3,000. And I think all three of us are definitely in the camp that, we're not going back to all-time highs anytime soon. So maybe we established the bottom of the range for the year. I know that's being really optimistic, but we are 130 handles off the lows from last week. A lot of support at the 3,800 area. In the area of limited resistance now. I mean, you can't really find a lot in the dailies. I mean, 34.50 was a daily high. We've already traded above it. Maybe it will just be that trading range kind of year, just with a little reset of the market. Of course, I don't like this retail news to start, after a good week, and you're thinking, hey, that was okay, but you don't like, Monday morning, definitely, at least in the retail land, not getting off to a great start.
So it's very important that buyers come into Lululemon and Macy's if you're in the bull camp. You want to see it. I'm not predicting anything here. I'm saying what you want to see if you are a bull is participants coming in and buying stocks on bad news. That's what you want to see, buying the dip, because that's telling you more of that sentiment. It could happen. It might not happen. I'm not trying to predict anything. I wouldn't be shorting them in the hole, though. I think today is going to be a tell because this earnings season is going to be full of more earnings warnings. I'm telling you right now. We haven't even got into it, and they're already starting to see it. It's going to be full of more earnings warnings. You're not going to see a lot of earnings raises. It's going to be more lowered guidance. So that market, if you're a bull, the market has to take it in stride, meaning coming in and saying, okay, yeah, that's priced in. We don't mind. And we're going to buy these dips on these stocks and buy them right back. And then the bulls really, got a case. But if they just continue to roll over, that's trouble. What were you going to say, Mitch?
No, it's going to give you a firsthand experience on Nike. And why do I understand like some of their margins are coming down? Well, just think about it in the case of Kyrie Irving, right? Well, I just bought his shoe, and there is a reason why I bought his shoe. Definitely don't support any comments he's making. But at the end of the day, they cut him from Nike, right? Just like Adidas went through their situation with Yeet or Kanye West. Well, that's affecting
anymore.
That. Yeah, I had to take a second there, but but in Nike's situation, that's causing that shoe that was at $130, $140 retail value to only go for $70 right now. And I think that this is what's going on in a lot of the apparel is that we're seeing discounted inventory. Retailers are still able to make sales at that point, but when you look into their margins, that's when you see the decline. So that's where I say look underneath the hood, and the retailers look to see how their margins are doing.
I mean, this Nike, like you're coming in and buying, look at the move it's had. I mean, we've went from 80 to 125, and this is where my problems lie, and this is why I just can't get in. There's so many value stocks. Nike would be in a value camp now. I know it's crazy because there's always growth stock, but back to the value stock. There are so many value stocks have just had such rallies that I'm like, what is priced in here? I mean, again, there's stocks making new all-time highs. There's a lot of stocks, we had a complete separation on XLE from USO. You don't usually see that, Joel, where USO has continued to go down. The whole reason that is that you've got multiple contraction in the Cathy growth type names, and you've got multiple expansion in, oil, and drug stocks, and some of the cyclical names. You've just got, the multiple expansion and contraction has been the driver of this market for the last 3 months. And that probably continues. But at a certain point in time, you got to ask yourself, well, if, the fundamental macro environment's getting tougher, do I really want to continue to expand these lower PEs on these stocks that often are cyclical?
What's the PE? What was the PE on Lulu before this news? It was
good question. And it's
high,
higher for sure. I'd say it's probably upper 20s. What was it, Mitch?
Well, I mean, I don't think it's updated, so I'd say 28.49.
Is that what they're saying? So, 28, 29. I mean, that's cheap for Lulu relative to itself, Joel. Lulu was carrying a 45.50 for a long time. So value investors, not maybe value, but maybe value investors start thinking about it. And the growth investors, will be saying, hey, this is the cheapest Lulu's been for a long time. Maybe we should jump in. But I don't know. Are we still? Is this a one-off? Like, is this just one time? And their guidance wasn't even that bad.
It was not that bad.
That's a little bit more of the concern here too. Is this wasn't that bad? They knocked $32 off it.
I know.
Like, they punish them. So maybe this is an opportunity. Part of me wants to say maybe I should just jump into Lululemon, and then part of me says give your head a shake. You've been calling for a recession for a long time. Do you want to own all these stocks, these retail stocks, if you're going into a recession? The answer would be no. So I'm just sitting out right now. Like, I'm honestly, and I've been torn for a while, and you know this on the show. Sometimes I'm very convicted. The last few months, I've been calling for a recession, but I've been wishy-washy, because I know some stuff has really been beat up. So it's like, I can't just go full short this market because stuff is really beat up. But I can't go full in this market because we got a lot of earnings warnings coming. So difficult to call this market. The Goldman Sachs guy saying a month and a half ago, 2 months ago, nobody can call this market. I mean, I'm in the same camp. This is a really tough market to call. That's why I'm doing a lot of day trading, a lot of chop, going with the flow. You get the, the Cathy names. Tesla starts rallying. Then some of the growth names start rallying. Bitcoin probably rallying because some of the growth names rallied on Friday. So Bitcoin rallies over the weekend. But, the relationship trades are still there. But to just flat out call this market bullish or bearish, tough.
I think Nike is a special and I get stuck on these things. And when I went to my local sporting store, and I knew exactly what I wanted. I wanted these pair of Nike shorts that I wore before, kind of wore them out, and they're like, well, Nike's not sending us stuff anymore. You got to go direct. So I think that's a point. Maybe they're changing their business model.
Well, they are.
Why would they do that, Joel? Why would they do that?
Because they make more money when I buy
margins.
Yes, exactly. I think it's a smart move. I don't,
not good for Foot Locker.
No, not good for Foot Locker and other retailers.
No, not good for Lulu. No, but I think it's smart, and so it's hard. These retailers are just, like Lulu, Nike, Macy's. I mean, look, we're talking about an icon, two iconic brands. You're talking a brand that was in the past, right? With the Macy's, they're all very difficult. The Nike one, I mean, that's just been one heck of a rally, and a lot of people have been underwater on it. This is like fundamental news in the sector, so I'll just keep an eye on that closing price from Friday. I believe it was in the 124 handle. That was the high close of the move. I mean, I look at that as major resistance now that that you fell back down. If it gets back above there, closes above there, works its way higher, then the street will just shake it off. The Macy's is still kind of in no man's land. down in the lower 20s. And I mean, I have bought some Lululemon stuff. I haven't bought it in a while. So I don't know. I just standing in front of these big down moves or these big up moves just hasn't seemed to pay as of late.
All right,
I mean,
let's
maybe we should
continue.
go into the segment, Mitch. We were talking about doing a little teaching segment.
You want to
and
do
I
that
just
right
think-
now? Okay,
Yeah, because this is
go
the way
for
the
it.
conversation's going and the chat's talking, and we're in a torn market here. But, the big rally on Friday, I think took a lot of people by surprise, including me and you, Mitch.
Yeah.
I think, I felt like it was a decent number. I felt like we could rally. I didn't think we were just going to take off and blast off into orbit like we did, though. It was very impressive for the Bulls, and then you have to take note of that. But, why? Why, does this happen? Why, when you've got some, tough macro environment, the stocks just don't go down. I mean, this market will always try to punish the maximum amount of participants. It's what it does. If the trade gets too crowded one way, it goes the other way. And it's because short-term flows. And maybe everybody is too bearish. And that can drive stocks up in the short term until you flip them to bullish, you catch them. And to your point, Mitch, you were saying maybe this is another bull trap. And that's how you build bull traps, is basically, getting these rallies and people, the momentum guys, like, here we go. Don't miss the bull train. We're going back to all-time highs. I mean, that's how you create bull traps. And that's what's worked, every single time for the Bears in 2022. It's been these vicious little snapback rallies that have suckered more people in. And then the train and the macro environment just knocks the stocks back down. But, to that point, energy has held up well. Drugs have held up well. There's certain sectors that continue to hold up well. January effect has been working to a certain extent in some of the growth names, but you know what? The value names have been rallying here too. So, you look at the XLE and the separation on the USO. But this market will always try to punish the maximum amount of participants. It's what it does. It's done that since birth. So when trades get too crowded one way, there's usually a vicious move in the opposite direction. So maybe we're just all a little bit too bearish right now. That's not going to drive us back to all-time highs, I don't think, though.
That's where it gets tough.
Yeah,
it gets tough.
Who's it in? Tom Lee, maybe, is he in the all-time high camp?
Oh,
yeah.
Tom Lee has been, and you know what? Like, we give Kathy a lot of heat. We never talk about Tom Lee on this show.
Mm-hmm.
He should be getting some heat because he has been so bullish. I mean, crypto, Bitcoin was going to 125,000 or 200,000. It was something crazy, the 2022 targets. And then they lowered the targets way down at the end of the year. And same thing for, obviously, S&P targets. They're all been all-time highs. He's been in the relentless bull camp. And I mean, that's their job. To a certain extent, it's tough on analysts. They can't come out. They've got clients. They've got a job to be eternally bullish because, they don't want to tell other customer base and the clients, oh, we think the market's going. I mean, you can make those calls, but if you're wrong, they're really bad calls. It's always an easier call just to be bullish because the markets drift higher in the long run, or at least over the last 100 years they have. So it's just an easier call. But Tom Lee's been wrong for a long time here right now.
And I think one thing that we go back to, and just to kind of put a bow on that learning lesson of the day, is always whenever we get to a certain point where we think this expectation is supposed to happen. Well, a lot of times, what do we get? The complete opposite of that expectation. And I feel like that's exactly what we got last week on Friday. Everyone was focused on the jobs number. And then all of a sudden it became the wage number that was the important thing. Yeah, so that's why it's so important to be flexible, especially as a day trader. Maybe as a swing trader, you can be a little less flexible, but as a day trader, and I know that's what Dennis does best, you got to be really flexible.
Oh, yeah. You can't even be opinionated as a day trader. You just trade what's in front of you. If you're a day trader, for the most part, I will bias every once in a while on opinion, but it's mostly just stupid little edges, and Paul's point in the chat here, great point. He was asking me, were you long XBI over the weekend? And absolutely. I talked about this trade a month and a half ago. There is a play to be long the XBI against the SPY or against, whatever you want to hedge it against. Mm-hmm. Friday night, taking it into Monday morning because we're seeing these little mergers come, and there's 2 or 3 more here this morning again. Where you've got little biotech stocks really rallying hard here because they're getting taken over. So the XBI is a 0.83% here right now. Full disclosure, I'm long XBI. I will sell XBI on the open because the play was just own it on a Friday, take advantage of merger Monday on the biotechs, and then dump it. And right now, I'm getting paid 0.4% for that against the SPY. So, yeah, I love that little strategy. These are the dumb little strategies that I play that make money. You say, oh, 0.4%. I'm not going to bother with 0.4%. You know what? 0.4%, if you can make 0.4%
every day,
20 or 30 times, not every day on XBI, but
know.
if you're doing this just once a week, you can get this play to work for you 20 or 30 times of the year. Those 0.4% will add up. So, I mean, these are the dumb little plays that I do in my day trading and overnight portfolio that make me successful. You know, identifying little edges. Nobody's going to talk about that on CNBC. It's boring. Who wants to talk about a 0.4% edge? We want to talk about a 40% edge. Home runs, the home run hitters usually strike out. You know, think about Rob Deere. Think about Rob Deere. We'll take it back to the sports. You know, he's sitting there. He's swinging for the fence. 30 home runs. It's a good season. Led the league in strikeouts there, too, because he's swinging for the fences every single time. It's those base hit traders, you know, those base Tony Gwynn, you know, base hits, you know, just keep coming at you. Those are the effective players in the long run. So base hits, 0.4% here, 0.2% here, 0.5% here as day traders, you're doing great. Those all add up. And if I can make 4, 5, 6% a month, it's going to be a pretty good year at the end of the year. So get on base. Don't swing for the fences. These little dumb little XBI trades, again, I'm going to sell this. I'm talking it. I will be selling this at the open. So I'm not saying you buy it now. The play is to buy them Friday night, take it over the weekend, and maybe it's not going to work out, but, you know, maybe you get a warning. But I just know a lot of these little mergers happen over the weekend in biotech. So you're trying to take advantage of the alpha, of the potential. I don't know which stock it's going to be. You know, the XBI is equal weighted. There's a pile of little biotech stocks in there, but there is a play to be long the XBI over the weekend. We talked about this 2 months ago. I'm still playing it. It's still working. Now, again, talking my book here, I am still long the XBI here. So I'm not saying now, I'm not buying it now. It's already priced in. I can see, you know, some people maybe, you know, thinking, oh yeah, we're going to go buy the XBI. You're late to the party. You're buying it now. I will be selling this at the open.
How many financial shows refer to Rob Deere in the Rob Deere strategy?
Stocks and
then come back with Tony Gwynn. I mean, Rob Deere probably hasn't been in the league. Has he even been in the league?
Who would you rather have?
Listen, Tony Gwynn, man. Boom, boom, base hit. But
base hit.
The old.
Remember, he led the league in hitting for how many years?
You guys got it wrong. You guys just need Money Mitch dropping bombs. Let's go.
Money Mitch, go for the haymaker.
Throw that thing up here.
Can you hit a fastball, Mitch? Can you hit like a 70, 80 mile an hour? Yeah.
70. I can hit 90s, Joel.
No, you hit
90s? I'll show you a video. I can hit 90s, man. Let's go. Come on. No, the fastest I ever hit was 94, 95, but that's just.
Did you stick your bat out, close your eyes?
Nah, I hit it to right field. I'm not gonna lie. I hit a line drive to right field, but still, hey,
that's impressive.
Let's do it. Let's get out of the learning lesson of the day. Now, one of the hardest trades that I would have to say has been China, because I know I've missed out of this rally, but will the China stocks continue to rally? Because it seems like they're definitely doing it. We can go to Baba, whichever way you want to look. And it seems like I did see some news that came out of Reuters that was interesting. They were talking about how people are joining long queues outside immigration offices in Beijing on Monday, eager to renew their passports after China dropped COVID border controls. Of course, this has prevented about 1.4 billion residents from traveling for 3 years. Will this pent-up demand start showing up? Well, one way that I definitely look at it is you can look at these tech stocks, but you could also look at the casino stocks to maybe see if they continue getting the lift.
The China stocks have completely turned. They're in a full-on bull market. The tape bombs don't happen as much, we know, because they just don't drop earnings warnings there very often. It's kind of a safer place to be for investors right now, which is a crazy thing to say. But the valuations just got to a ridiculously low level, and the stocks are starting to come back here significantly. So China's been in a bull market here for the last 3 months. You think about the value trade, and it's going to come off, and maybe it comes off in overall stocks. But I tell you, the China stocks are in their own market over there, and they really got beat up. I mean, they took BABA to an all-time low almost, which is unbelievable. So, I mean, we're just retracing a little bit. These things are still relentlessly killed from the highs. You know, BABA was $300, $113. Baidu was $350, $133. They're really beat up, but the multiples are low. These aren't like your Kathy nosebleed PE names. The PEs on these things are all pretty darn low. And that's maybe the difference here is why these have the sustained bid, because you got the multiple expansion here, and you still are in the tech sector for a lot of these names. So maybe you're seeing rotation even from US tech to Chinese tech happening here. That could be happening too. I think you're a buyer of pullbacks on China stocks here. It's crazy to say. Again, I'm very underweight because I'm still don't know this overall situation, but nobody's talking about that anymore. If there was ever a time where China kind of feels safe, it's kind of right now.
Right. I think I saw something about loosening up some borders. Thought I saw a headline flash on that. This stock is over doubled since the October low.
Yeah,
The gap and go on Friday.
yeah,
Tough one to trade this. I mean, I know you're looking to buy a pullback on this thing, and who knows? I mean, you'll definitely get some bad news and some potential gap fills, but think about the potential upside in this one. I mean, this stock was $310, right?
yeah.
$315, and they came 319.32 was the all-time high, and they came out. I wish I would have kept it on my charts because it was like warrant, like and IPO canceled. Boom, down 30. Then it just kind of hung up a little bit, and then boom, something else. Boom, down 50. Then it hung out a little bit, and then the news came out again. So now the news flow is turned on it. For today, just hanging out at 113. I mean, there's nothing on the monthlies here. I mean, the way this thing, maybe you got over 120 a couple times. Wow, your next monthly high is 125, 84. But right now, just kind of hanging out at 113. I saw Baidu caught a bid too off this, up 274. That has a long way to go on the upside. The only one Billy, I saw going the opposite way. I don't know if that had some news on it.
Yeah,
Or
it's
not.
down here. You do see Billy trading down, and it's its own animal too. And again,
Okay.
Bill, but what's the P on Billy? I don't know. I don't know if this is one of those low PE stocks either.
I don't even think I have.
You know who started this? Maybe we'll keep an eye on Pinduoduo.
Oh gosh,
because-
that's been a monster
Yeah.
mover. $40 back in October. He's talking about stocks up 130% here in the better part of 2 months. It's been a big move. Is it too late? Like the question though, Joel, now, is it too late on these names, or do you just buy pullbacks and go with the flow? As a day trader, I'd say it's not too late. As a swing investor, as an investor, I don't know. Maybe you want to have these on your shopping list, maybe. But I don't know. I still have trouble investing in China. I don't know. I can't break that. And I do own a little bit of emerging markets funds, so I do have a little bit invested in China just for the diversification purposes. But I don't own any stocks straight up in China anymore in the long-term portfolio. Maybe we should.
Well, Billy's filing for a stock shelf, and that's why you're seeing it down there. I saw that reported this morning.
A little dilution for you.
Yeah, a little dilution for you is affecting that one. So just to kind of bring that up. But let's keep moving. Let's get to another headline on the day. Of course, Goldman Sachs is expected to slash about 3,200 jobs this week as we continue to see this headline hit the tape and actually help stocks. Wonder how long this actually exists, right? And how does it hold? Well, it looks like Goldman Sachs is coming up this morning. We'll see if it can actually get back above the 350.
Does not, as we continue to get layoffs, and I know the market is applauding, it seems like every time we lay off some people, maybe it's a drop in the bucket and it's, not a lot of big numbers we're talking about, but it seems like we're, the Wall Street's happy for layoffs here, but doesn't it come full circle eventually as more and more people get laid off? Yeah, they get a severance and they're good for a bit, but eventually these people need to get jobs. Like, doesn't it come full circle here into the economy? I don't know. But I guess we cheer for that right now because we want the labor rate to get worse here anyway. So it's a weird market. What you're cheering for and what you're not cheering for as a bull. But regardless, the market's been applauding layoffs for a while here now.
Didn't Amazon? Wasn't that what day did they give their layoffs? Because I think
it was Friday morning, wasn't Thursday night, Friday morning, I think.
Oh, okay.
Yeah, I'm pretty sure it was Thursday night, Friday.
Because they gave it back. I mean,
CRM did too.
Yeah,
temporarily, and then we had the vicious rally Friday, and then that makes it all look okay. But yeah, you're right, Joel. Those stocks wanted to give it back, and then the market, the vicious rally on Friday, rising tide lifts all ships, and I mean every ship was lifting on Friday.
Goldman Sachs, easier to give you guys support. It's not going to do you any good right now, but that 340, I'd just be hanging on the long side. That's $8 away. Now on the downside, there are, or excuse me, on the upside, they're not really moving this thing. I'll just keep an eye on this close right here at 348. Your high on Friday, 349. S&Ps are following through nicely through their Friday levels. This isn't. That would make me a little cautious. So see what happens at 349. If you want to be all giddy, real bullish, and say, hey, we just had a 50-point break, right? Excuse me. Yep, 290 to 340, 25. Let's go back up. Let's fill this gap. If I was looking to sell this, wanting to rotate out of it, I'd say, hey, come and get me 360, 362, 363, get back half of that move. But so far, 10,000 shares have traded, and we're still unchanged here, Goldman Sachs.
We'll see what happens there. It looks like it's 8:36. That means it's time for our guest today. You guys get excited. Shake it, Dennis. You know what time it is. It's Market Structure Mondays. Tim Quast is back with us, team, as we're excited to bring him back on and talk about Market Structure Edge. So I'll let you take lead, Joel, but it's good as hell to have you back, Tim. Definitely.
Happy to be back, guys. I missed you. Happy New Year. Good to see you.
Where are you today?
Where in the world is Tim Quast?
That's a reference, Mitch. I'm not sure everybody would get, but I'm right with you.
Carmen Sandiego.
Exactly.
That's old, Mitch. That's old.
I'm an old guy. What can I say?
I'm in Austin, Texas today.
Austin, Texas.
It's getting weird.
What are you doing in Austin?
It's a family thing. There's a big
it's getting weird with it.
Celebratory bash for my wife's mother who just turned 80.
Oh,
so that's,
shout out to her. Shout out from PreMarket Prep.
Birthday, Mom.
Happy birthday, Mom, out there.
80 years old.
80 years old.
We're all hoping to make it to 80 years old. That's right.
Yeah.
Life expectancy. If we can make it to life expectancy under, being day traders and the stress and all that, we're doing pretty good. So congratulations, 80 years old. Nice number.
Thank you. I was hoping to die gloriously in battle, but it's apparently too late for that. So
Tim, let's talk about that rally on Friday. Should stocks rally on weaker wage growth as they did on Friday? And just another thing, too, was, if you hit that headline number down 3.5%, you're like, wait a second, what happened? It didn't take long for the market to react to that. But just talk about the way the market's reacting to the news.
And I don't know if you've had any conversations about this, but, one of the things that I return to repeatedly for you traders, just to remind you what actually drives the market so that you're not fooled, is that would it be rational for a consumption-based economy? Keep in mind that our economy, the United States economy, if you're talking about the drivers behind gross domestic product, GDP, that roughly, give or take, 70% of that comes from our consumption. That is the things that we buy. And so should a market rally dramatically because the rate of wage growth is slowing, that is the amount of money that people are making and the degree to which that is increasing diminishes, so therefore stocks should soar. Well, it's completely cognitively dissonant to think that it would be good for stocks if people have the capacity to consume less. I just want you to be aware of those sorts of things. And I talk all the time about how the headlines are often an attempt to explain what the market does when the market does things that appear to be irrational. And it's not that the market is irrational. It's that most of the behavior in the markets doesn't come from people thinking about what they're doing, but rather machines that calibrate prices and models that help people determine, well, where are we going to put money? And so this, to me, was a classic example of it. It's not that we didn't expect it. I had written in our market desk notes to edge users that the data, if you looked at the supply-demand balance heading into the new year, and you compared it to historical precedents, that there was a 100% probability that stocks would rise, because they always do from this level. So it wasn't a surprise. I used it certainly to take gains and not chances. I had a big position in McDonald's. I mean, the stock did great. Those were things that I could be very comfortable about. But it's not rational for stocks to soar because wage growth is slowing and the central bank might change the rate at which it increases the cost to borrow money. And I don't know, you'd say, well, all I care about is I just want to trade stuff that makes money. I get that. I understand that. But I want you to understand the risks and the opportunities. And that is not rational behavior. The market shouldn't move hundreds of points, 2-3 percentage points, because the central bank changes or might change the cost of credit. That shouldn't drive the market. That it does should tell you not to have an expectation that it will necessarily behave rationally. And so then that has to feed into how you think about trading. And we can get to that.
Let's jump in and start looking, at the market structure on some of these different names. You mentioned McDonald's, and it's an interesting case because this stock has been in a relentless bull market where the rest of the stocks have been in a bear market. Clear uptrend if you bring on the 2-year charts. We're not far from all-time highs. Obviously, defense, you're going into a recession. People still eat at McDonald's because even though their prices have went up, it's still relatively cheap to everything else. So, and I mean, kids like McDonald's. My kids like McDonald's. They're not going to stop liking McDonald's all of a sudden, because, the people have a little bit less to spend. So what's it look like on McDonald's? Are you still in this trade? And if not, why did you get out?
So I'll take both pieces of that. This is supply. So if you've never seen market structure edge traders, the basis of edge is that there are rules that govern how stocks trade, and they all have to follow them. If they're part of the national market system, the same rules apply to everything. And therefore, you can measure supply and demand. And the green part of the graph is demand, and this graph down here is supply. And so when demand stays steady and supply drops, there's a high probability that something benefits from that. The price rises. There can also be rising demand, falling supply produces a different kind of outcome. This to me is what I'd call a low volatility trade under normal circumstances.
Yeah.
That's spending a lot of time at 5. That is the kind of condition that I like to be in when there is uncertainty. So I am not in it, but I can always buy it again. This is how I think about it. All that matters to me is, do I keep the gains that I've generated, and do I enter at a price that is better than when I leave? And there's more to it, but that's my thinking. So when McDonald's moved well more than its volatility on Friday, that was a very good reason to me to leave. And again, I can come back, particularly if the price drops. But I would look at this equation where demand is steady and supply has dropped sharply, but now it's begun to reverse. Will I return to McDonald's? Maybe, but there might be something else that doesn't have this little uptick in supply. Supply, by the way, is short volume. It's the thing I get asked about perhaps more than anything else on Twitter, because there's this belief that there's phantom stock in the market and a lot of shorting, naked shorting. Well, it's not true. Naked shorting is illegal. It's against the rules. You can look at the threshold stocks. Those lists are published, and you can look at them, and it's generally ETFs that land on those lists. Those are stocks that where there has been a failure to deliver. Somebody has borrowed, they have a certain period of time to cover it, and that hasn't happened. And most of the time, it's a handful of stocks, like 20 stocks, and 18 of them will be ETF. So that's not the problem. The problem is there are rules that govern the supply side. The SEC permits the creation of stock to facilitate the presence of 100 shares at the bid and the offer all the time. That's what happens. And so,
you talk about that all the time, but what if they didn't do that? What if they didn't allow this? We need liquidity. We've unfortunately, got rid of all of our human market makers. We don't have very many human market makers left at all here anymore. It's all bots. I mean, what if they didn't allow this? What happens then?
Well, you're absolutely right. If you look at the trade size, the average trade size in the S&P 500 last week was 100 shares. We measure that data every day. And 100 shares is the exact regulatory minimum to make a quote at the bid and at the offer. You back up 20 years ago and it was 1,100 shares.
Yeah.
And so what would happen if there was nothing? Well, traders, you would go to buy or sell 100 shares and you would not be able to do it because there simply would not be any supply. The market is very illiquid, really. And so it depends on almost half of the volume. In fact, it's over half right now. And the S&P 500, by the way, users of Edge can look at this every day and know exactly where the market is. Well, the market right now, sorry about that. The market right now is 50, a little over, it's 50, all the same as 51% short. 51% of the trading volume in the S&P 500 is coming from borrowed or created stock. But it makes it possible for you to trade things at a penny spread or less. So what would happen if we didn't have that system? Well, there would be violent volatility and many times you would be unable to fill a trade. It's a whole long discussion about the stock market, but it's which is the lesser of two evils. It's a big question.
Yeah, and I mean, you're going to have liquidity on your stocks like Bank of America. It's this littler stuff too that sometimes there's just, Joel calls, these stocks, trade by appointment only.
Right.
And I mean, people want to go trade those things to go and find. And I mean, really what the liquidity providers, market makers role is to do that time gap where you've got a buyer here that wants to buy today, but a seller that wants to sell tomorrow. What the liquidity provider is really doing is, helping you out with that gap in time, especially on some of these smaller stocks. So it's a difficult thing to just say, yeah, let's get rid of all these rules here and let's just let, whatever happens, and we don't need any market makers at all. I don't know if that's a good idea either.
I agree. And the reason we talk about these things, folks, Edge Mob, is so that you can be a better trader. You have to have a basic comprehension of the mechanics of the market so you know what's coming. Just like if you were playing football, you got to know the rules.
Yeah.
Otherwise, you will be caught out. You'll be surprised. Well, the same thing applies here. I agree, and I always check this. Right, this is I'm going to check supply and demand. It will give me 2, 3, 4, 5 days. That's the advantage it should give a trader. You have 2, 3, 4, 5 days to produce a return or to get out of something when you see supply and demand changing. And it should factor into, I'll look at the spread. Curiously, McDonald's at times, as I was leaving it, had a spread of 40 cents between the bid and the offer. And, you could trade some little stock like SYNH, which has a lot of volatility, but had a good supply demand balance. And the spread was 2 pennies. So why would McDonald's have a spread of 40 cents? Well, I mean, it's a higher price stock, but those are things that you want to look at. That tells you about the amount of liquidity in a stock.
All right, let's keep moving now. One of the areas that definitely has been interesting is the industrials. We saw CAT make a decent move on Friday. Let's take a look at how maybe CAT's performing or other industrials. I don't know if you have a watch list for that, Tim, but let's dive deep.
We could do that. And as we do this, Mitch, I want to point something out that ties back to why stocks moved the way they did on Friday. So on the dashboard and I trade these too. And everybody at Edge has them. Momentum or low volatility. You're either capturing things that are likely to outperform the market, or when the market's rising, that's momentum. They have greater volatility, or they're likely to avoid big swings in the market, but still give you a benefit. And those are the things that I use all the time. And this is demand and supply. So if demand's stable and supply is falling, that's what I'm looking at. But look at this. I don't know if you can see this, but across all of these tiles, every tile represents a portfolio. Look at the key behavior. Passive, passive, passive. You could go all the way across my entire dashboard. There is not a single way that I have clustered stocks to look at them that was led by active investment in the last week.
How do you come up with that? Like, I don't want your secret sauce here. I know this is
Yeah, we do.
in behind, but how do you like define whether, because that's a difficult thing to figure out. How do you find whether it's passive investors coming in or active investors coming in? And maybe you should just tell the difference. Tell everybody the difference between passive and active money.
So, and they're exact opposites. So passive money trades characteristics. That is, it is BlackRock, Vanguard, and State Street, or global macro hedge funds, or any model that is interested in characteristics. Passive equals characteristics. Is it market cap? Is it industrials, Mitch? And we're going to look at that. Is it volatility? Is it other? You could have a model with all kinds of factors in it that say I'm looking for rising, accelerating earnings and a top line growth of 15% or more. Those are all models. And most of the market uses models. If you look at the data today, now how do we get to that, Dennis? We have built algorithms that look at how you have to comply, and there are coming changes to these rules with the rules 605 and 606. All orders have to be executed according to rules that the SEC has established. And it's like watching a decathlon. There people huck the javelin, people run the hurdles, they do different things, and those events can be defined by how they are different from other events. Well, orders are the same. Orders that run through the market changing the price are different from a large value investor trying to get a whole bunch of MCD at the same price.
Right.
We can see how those trades execute, and it helps us model what the key behavior is. So and then active money. So passive money wants to be the benchmark because it's tracking characteristics. I want to perfectly match industrials, whereas active money picks stocks. What makes this stock better than that stock? Because I want to beat the benchmark. And then you have fast trading, which is trading price. And over half of all market volume derives from that. And then you have derivatives as an end unto itself. Maybe I buy and sell puts and calls. Well, that falls into a bucket we call risk management because it's about using derivatives to produce a return. But you could look across here and see those are the only two behaviors that set prices everywhere in the market, therefore establishing that the market did not move on fundamental factors last week. It moved because of machines and models. Looking at industrials, here it is, Mitch. So here's industrials, led by passive, 426 stocks in it. And here's the supply demand equation across all those 426 stocks. Not bad. Demand rising, supply falling, dipping just below 50% on average across the whole group. That's not bad. When either side changes, that's when you want to be out of industrials. So if you're buying an industrials ETF, pretty good time to do it. When either side changes, leave. It's that simple.
I got one for you.
Okay.
I'm going to take a stab at it. Maybe you guys want to too. Tesla.
Okay.
Hey, don't pull it up yet. I'm going to say between 3 and 4. I'm going to go with 3.5.
3.5. Okay.
And what's going on with the volume though, Joel? Is it short volume? Is it going down? Is it increasing? What would you say, Joel?
I would say that the short volume has been decreasing, obviously, because we've had a little bit of a bounce. So that's my call. All right, survey says.
Okay, let's see what
we
got.
It's fun to try to guess. Sometimes he's right, and sometimes he's way wrong.
So here it is.
Joel. Sentiment is still in the gutter.
Sentiment is still 1, and now supply is rising anew.
Ooh.
1.
This is a bad recipe.
Yeah. It is not a good recipe. That is exactly right. You don't want to buy that. You want to buy the opposite: rising demand, falling supply. Well, that's how you protect yourself. It's not whether you own Tesla, it's when. Just own it when it's going to deliver returns for you, and don't own it when it's going to hurt you. Or if you're shorting, that's probably still a pretty good short.
I can tell you the discrepancy. You got a closing price at 113 and it's trading at 117. So there's a little bit of the discrepancy. Go ahead, Dennis, and then we'll wrap things up here.
But your system, Tim, and I just want to get this. Yeah. You're more of a momentum. You're not trying to catch the turn, like the actual turn in the bottom in Tesla, because that's what I'm trying to do sometimes, and it's the wrong move. But you see a stock that's going straight down, 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 down. You're typically not going on that day one where it's turning. You're kind of, your system's probably waiting for a little bit more of a turn where it feels a little bit safer. Am I correct?
It's a central tendency, because here's how I think, and you're a very sophisticated trader, Dennis. You know a lot, and you're going to be able to, and you, Joel, you're great experts at the market. You're going to have an advantage. So for those who don't have the time to sit and watch screens, but want to be where the competition is least, because you can't beat the machines, probably can't beat BlackRock, Vanguard, and State Street because they're too large. What do you do as a trader? Well, you want to be between them. I say when you're trading supply and demand, you have days rather than minutes or hours, and you're sitting in a spot looking at supply and demand, not looking at price. I don't trade price. I really don't care what the price is. I want to have the strongest possibility that my trade produces a return, not today or tomorrow, but several days from now. That's how I think about it. If you look at Tesla in a portfolio, here's the point to me. It's a very good tool. And Dennis, I don't know whether you'll agree or disagree. Tesla is a consumer discretionary stock. So we'll go into that portfolio, which doesn't look good. Its short volume is coming down and supply is rising, but it's way over 50%. I would avoid consumer discretionary simply because short volume is too high. Supply is too high in the entire group. But let's look at Tesla's volatility. This is key for edge traders, and they're edge users who are so good at this. I've had a guy send me a note last week. He said, I've used this now for most of the year, and I've made money 100% of the time following this. And he's after just 2%. He just says, I want 2%. I have put my stops and limits so that I produce 2%. And if I do these things, it produces every single time. Tesla moves 8% between intraday high and low on average over the last 5 days. Now, it can be skewed by big moves, but that's extraordinary. So if Tesla were, say, down 3 or 4% and supply and demand are diverging, that's a great time to buy because you're almost assured of producing a 3 or 4% return. That to us is a way to think about the market that reflects everything that is occurring in it and increases your chance of producing a return, traders, rather than trying to guess where the price is, or is it properly valued, or how should I think about the Tesla cutting prices on vehicles? Is that going to be good or bad? You don't have to worry about all that, because all of those things are inputs into supply and demand, and you don't have to know all of them. You can just see it. That's how I think about it. I'm biased, but I think it's helpful.
Sometimes it's good to take out some of the discretionary part of it, right? And definitely threw up the link there for you guys to get your own demo. Of course, check it out, your own trial, 30 days now, and definitely check out Market Structure Edge.
And you can get $40 off the monthly rate. It's not an inexpensive tool because there's no other tool like it, but you can using Benzinga, all caps, and you will get $40 off the monthly rate.
Well, thank you for joining us like always. Tim Quas, Market Structure Edge. We'll have you back on. Have a good one, Tim. All right, let's take a look into the markets. How we looking, Joel, into the open almost? We're in 8:59, 8:58.
We snuck above our December 16th high.
Oh, it looks like someone was looking at the cat. Throw up the ES for me.
Oh, I'm sorry. We wondered why that was just consolidating near all-time highs, and boom.
I've been wrong on this one. And there you are. You got to break out here again to all-time highs. I do not get it. I'm not long it. I actually had a short position overnight, covered it again. I'm trying to short it overnight, I'm not in it now so I can freely talk about it. It's tough. It's tough to just start shorting stocks and making all-time highs. It's really tough. Yeah. So it's been a trade that I've been wrong on. And I do think eventually I'm going to be right. I just think I'm way too early here.
Well, what the thing, we don't have time to talk about it, but Tim, talked about the 70%, consumption, market. And if you think about the technology stocks and where their percentages are and components of the S&P 500 index, and we've seen some wicked rotation. I mean, we could see a lot more of this, coming for the remainder of the year. If that statistic is correct. But anyways, S&P's up 17 handles. Let's take out the pre-market high. I have nothing for you on the upside. No levels. Nothing. Absolutely nothing here. Looking at the S&P, you have this daily high here. This was the CPI number from last month, right? Where it's good. No, it's bad. Well, actually, it was this day. So you're just working back into this area. CPI on coming out on Thursday. I mean, I think it's hard to fight the upward trend, at least going
I
into
think
that
people are
number.
buying ahead of it too. I think there's going to be a lot of expectations that inflation is coming in, and here we're going to get another print. So you've got, we definitely have something working in the bulls' favor too. Just simply, and we can say, oh yeah, stuff's oversold. But the other case is that inflation is, starting to come in, and I mean, as we see more consumer, Macy's a little warning. I mean, that stuff just telling you that, hey, demand is slowing. This is what the Fed wants. So that does get us, closer to an eventual pivot, but we're a hell of a long ways away from there. I just can't get on this full bull train. I think they're going to buy it ahead of the CPI. I think the CPI could be a decent number. Maybe we even rally into it. I was joking with somebody on the weekend. I'm not even know if I'm fully joking, but somebody was saying, we're going to 4,200 off this CPI. And I'm like, if we go 4,200 off this CPI, I might go to 100% cash. I might actually sell my other half of stocks at 4,200 and go 100% cash, because I don't think there's no way in hell we're going all-time highs. And maybe I'm wrong, and maybe the CPI does do that. But I'm telling you, if the CPI if we go to 4,200 on the S&P because of a good CPI print here, I'm going to sell more stocks and raise more cash. And I'm going 100%, but I will sell more stocks, because I think that's just going to be an awesome opportunity, because I think there's still a lot of pain ahead, because I think eventually the narrative is going to move away from inflation coming in and more into, oh my gosh, we are going into a recession. I think the narrative will eventually move there. I'm usually early, but I'm often right. So I don't know when that's going to happen, but I think the narrative, Joel just snuck away because he knew I was going to ramble for 5 minutes. I think the narrative eventually changes from worrying about inflation to worrying about recession. What do you think, Mitch? I mean, if we go 4,200 on this S&P, are you buying stocks up there?
Nah, I mean,
maybe we could buy them today and sell them if we go 4,200, but I'm not going to make that call.
Joel taught me it best. Keep it simple, stupid. Until the Fed turns, I'm not turning. I'm just keeping it that simple. Either you guys can complicate things by looking at this little data date here, this little data there. Well, the truth is, and you guys can see it with this chart, how much have we really gone down on average earnings growth? Not much. It just shows a slightly tick down.
And if we start to really go down, though, Mitch, that's more proof that we're not going to have a soft landing.
Yeah, I mean, it's going to be tough, team. And I think the overall thing to keep in mind is, how long will these interest rates stay high, and when will they actually cut? That's when we think bull market, right? Not right now. I think there's too many people trying to think new bull market every time we get a rally.
New bull market right now. I think we still need to think about the second half of 2023. I think there's more pain ahead. I think there's more earnings. I think there's more Lululemons. I don't think Lululemon and Macy's is a one-off. We've been predicting on this show about potential earnings warnings coming. Here, boom, we are like a few days into the year and we're already getting them. We're not even at earnings season. It starts Friday. We get JP Morgan, Bank of America, Citi, Wells Fargo. UNH is going to report, but they're obviously, more recession proof because people, still need health care. But that's really when we're going to get kick-started here. Yes, we're going to hear from KB Homes on Wednesday. If you just want to quickly look through, we're going to hear from KB Homes on Wednesday. Taiwan Semiconductor, I believe, is this week as well. And then Friday's the banks. And then we start getting to those big techs. But right now we're in that little window. I'm like, if you were going to warn, you're kind of in that window a week or 2 or 3 weeks before. You are in earnings warning season here right now. And just like Lululemon wasn't on the agenda to report, but boom, you get hit with a tape bomb from them. And it wasn't even that bad. I mean, this market's going to knock you down 10% for, that earnings warnings. What if we get a real doozy? So I just can't, I think there's so many potential Tommy Lackey. We love you for that term. And I'm going to use it again, the Tommy Lackey term, tape bombs. There's so much potential for tape bombs here that I can't just be 100% in this market, because a tape bomb happens. You know how quick it'll turn, Mitch? It'll turn so fast you won't even have a chance. I mean, as a day trader, you'll have a chance, but as an investor, you'll be looking and saying, you're not even paying attention to the markets. Next morning, we open down. What happened? Oh, well, Apple warned. I'm like, whew. So I'm just scared of the potential for tape bombs, and that's why Yes, maybe we're going to rally on the CPI number. Yes, maybe, but I think it's going to be another selling opportunity. So I hope we go to 4,200. Somebody else was saying in the chat too. I really hope we do, because I will sell more stocks.
We'll see what happens. Go do what you do best, my friend. Get to your trading. If you guys want to keep up with Dennis, you guys can always do so on Twitter at Triple D Trader. One of my favorite follows, like always. Got to always hear what Dennis is saying out there. But catch it, team, on Twitter. And who knows? That's what it's all about. One thing that it is, we don't hide, Dennis. We don't hide.
No,
have a good one, my
I've been
friend.
wrong.
Yeah.
You know what? How do you know you're wrong?
About.
You start losing money. That's how you know you're wrong. When you start losing money, the trades start working against you, and you got to, I'm not going to hold a stock short going all-time highs. I might short it as a day trade, but I'm not going to short it overall and just say, oh, it's making new all-time highs. It's eventually going to come back in. Short stocks making new all-time highs, you get killed. So there was a play for Cat, starts making new all-time highs. You can't hold it. You got to just, let it play itself out. And it doesn't want to go down. It's not working. I can't fight that tape. I'm wrong. I'll come back in at another point in time. Tim Quast, fantastic today, saying you don't have to stay in the trade. You can always rebuy. Well, you can always re-short too. You can wait for Caterpillar to top out and give you another opportunity. But I got no business being a short of stock making new all-time highs. It was trying to hold that 240. I thought it might pull the deer, and apparently it looks like I might be wrong on deer too, although I'm still 15 points from where I got bearish at. But I'm looking at, and I have no position in either of these at this point in time. But, it's making new all-time highs. I'm not going to be short stock making new all-time highs.
All right, that's going to do it for us here on Pre-Market Prep. Have a good one, Dennis. We'll see you tomorrow, my friend.
Good luck, everyone.
Take care. All right, that's going to do it for us on Pre-Market Prep. Like always, want to go ahead and introduce you to what we're doing next. Now, I do want to give you guys over to Benzinga Live and, of course, trading action that's going to happen next. But we do have something new here at Benzinga. Want to teach you guys and tell you guys about the Benzinga Stock Market Book Club. This is going to be by Money Mitch, and it might include one other special guest, but still working on that aspect of it. Join a community of learners, traders, and market enthusiasts as we go through, of course, some books, financial books, stock market. It could be on psychology, patterns. It could even be on retirement. We're going to be going through this together as a team. So join us and join the weekly newsletter. We'll go chapter by chapter, week to week discussions where you guys can join in. Yes, I said it. You guys get behind the scenes here on Benzinga. What do I mean by this? Well, everybody that's in the club is going to be a part of the recording. And the recording is definitely going to be longer than what we put out. And that's going to give you guys some more insights. You'll be in the discussion with myself and others, and you guys can join. We'll have up to 8 guests with us on every single show for the book club. You don't want to miss it. It's going to be the best part of the year. At least I would definitely say so. So join in, team. I'll give you guys the link here. Here's the book club. You guys can join in. We got, a good amount of people already joining in. And I think that one of the important parts is that we're actually not only going to be reading these books, but actually looking for real life examples and talking about them with you guys. Up next, live trading. Don't go anywhere, team. Hit the thumbs up if you guys appreciated today's show and everything we do here at Benzinga. We'll see you guys over on live trading up next.